What if the reason most startups fail isn't the product, the team, or even the market, but the moment they choose to scale? Today's guest literally wrote the book on just this. Mark Roberge was the fourth employee and founding CRO at HubSpot, taking them from zero to IPO. He then joined Harvard Business School, where he teaches sales and entrepreneurship, before founding Stage 2 Capital, the first VC firm backed by over 1,000 sales and marketing leaders. He's invested himself in 100 plus companies, sat on countless boards, and now his brand new book, The Science of Scaling, is out right now. In this conversation, we get into why obsessing over revenue growth is killing 80% of Series A businesses, why your first sales hire could make or break your company, and the one metric Mark checks before he invests in anything. This is an episode you genuinely don't want to miss. So if you are not already, please hit subscribe and leave us a like. It really does help us to grow the show. Rev-n-u Unplugged is proudly sponsored by Indigo, a go-to-market recruitment consultancy specialising in placing elite senior sales talent for high-growth technology companies across the US and Europe. If you're scaling and need the right people, Indigo can help you. Okay, grab a brew, get your notepad ready, because this one is packed with some great insight. Here's my conversation with Mark.
Welcome to the latest episode of Rev-n-u Unplugged with me, James Hounslow, and today I'm delighted to announce that we've got Mark Roberge on the show. Mark, welcome. Thank you for joining us. How are you doing today?
Good, James. Thanks for having me.
Before we get going, I've got lots of questions to ask you. You've got a book out this month, which is super exciting. If you could just give our audience a bit of background as to who you are, what this book is all about, because that will set the scene for the rest of the conversation.
Sure. I'm a passionate entrepreneur operator that I suppose like about a decade ago, I guess you could say graduated into my second career of teaching and investing. So the last startup I was a part of the early team at HubSpot. I was the fourth employee and served as their founding chief revenue officer for 9 years, from zero to IPO. After that, was invited to join the faculty full-time at Harvard Business School to build and teach their courses on sales, which also gave me a lot of free time to continue to express my passion of entrepreneurship in a different way. This time as an independent board member, an angel investor, and that work about 6 years ago evolved into the founding of Stage 2 Capital, which is the first VC firm run and backed by over 1,000 sales and marketing leaders across tech. So that's kind of an overview of my background, sort of like operator turned teacher, as an investor and teacher. And this particular book, I guess the books write themselves, as they say, James. I never, even my first book, I didn't intend to go be an author or write a book. Kind of found myself in the last decade in this extraordinarily interesting flywheel of like sitting in boardrooms and seeing patterns and then writing about them. And sometimes they lead to a speech, which lead to more writing, which leads to like codifying it for the classroom and the students beat it up, and then it's a circular flywheel. And this particular work, it was probably the biggest driver of failure that I've seen, unnecessary failure, has been when founders choose to scale the revenue and how fast. And I just feel like that particular strategic decision is so critical and yet has the least amount of rigor that I see amongst executive teams, founders, and boards. And the first time I reflected on that, I did a speech in 2019 for Jason Lemkin at SaaStr. And I think it was like one of the most watched videos for SaaStr for a couple years. And that just led to more speeches, more writing, more classroom. And then eventually like Stanford University was like, can you write this up? Like a year and a half ago. And my publisher, Wiley, called Right of First Refusal. So that's how we ended up with the book, is a work that sometimes you stumble across one that's timeless and very abstract, whether you're selling software in Silicon Valley or tractors in Japan or pharmaceuticals in Brazil, and that's what it's about. And all the proceeds are donated to mental health. So that's another big purpose driver for me on the work.
And what's the book called?
It's called The Science of Scaling. Yeah, using data to understand when and how fast to scale revenue.
It's It's a topic that's quite close to my heart, being a go-to-market recruiter, because I've been doing this for 20 years myself, and it's really interesting because I get asked all the time about one of the biggest fears that founders have is hiring and getting hiring wrong and it costing huge amounts of money. But they don't often get hiring wrong. They're just not ready to hire, or they don't know what they need to hire, but it automatically just gets blamed to the person that's come on board. So I'm really looking forward to this discussion and the insight that comes out from it. So I've got a bunch of questions that we're gonna run through here and chat through, because I think it's a really important topic, particularly for 2026. I don't have exact figures, but I know 2025 was one of the most challenging years for revenue hitting target, and I think 2026 needs to be a bit of a bounce. I think there's more money to be spent on technology, but businesses have to be ready and in the right position to take advantage of those. I'm going to take you right back to where it is. I read the ebook online, and you open with a pretty big statement. We're obsessed with revenue growth, and it's killing 80% of Series A's businesses. What I'd like to understand from you was, when was the aha moment, either at HubSpot or Stage 2, that made you realize this wasn't just a problem, but the problem?
Yeah, it really came down to those, like, the first 5 years after HubSpot, where I was spending probably half my time just teaching at HBS and helping, I was, a lot of my students, and I usually teach about 500 a year, were starting companies and just kind of watching their patterns. And then the other half of the time I was spent helping the VCs that originally backed HubSpot, so Sequoia, General Catalyst, and their portfolios on this. So it was kind of like the first time in my career where I wasn't spending 80 hours a week on one company. I was spreading across thousands. And then again, as I mentioned, eventually that turned into Stage 2 Capital, and we've invested in 100 plus companies through that vehicle. And that was just really the pattern of, like, why, there's been additional IPOs through that journey. There's been additional billion-dollar valuations and exits. And there's been a bunch of, like, sideways, 1Xers, bankruptcies. This is the game we play. And it was just a time for me to be able to reflect on what caused the rocket ship versus the fallout. And they just kept coming back to, like, the readiness to scale and the correct pacing. That's what inspired that work. And if you look at my background, I've spoken on 50 other topics over the years, all of which I think are important, but this just one stood out as the most important, and it happened to catch a lot of attention from the community too, that they were like, hey, this is totally right. I'm so glad you put this out. This helped me to get through the next 2 years. Oh my gosh, I wish I saw this 3 years ago, because my startup probably would have survived had I seen it. So it's just like, you put it out there to the masses, and you can kind of tell when something's really resonating as truth.
I mean, something had to change from it. But you spent years building this framework, the LIR formula, the 3 stages, the speedometer. It's rigorous, it's data-driven, and I love that it's scientific. But I want to know about the moment when you may have doubted all of it. Not publicly, not in board meetings, but privately. Maybe when you were driving home, you're in the shower, that voice that says, what if I'm making it too complicated? What if the founders who just trust their gut and move fast are actually right? Does it exist, that voice? And if so, what are you saying to it?
Sometimes I think it's somewhat de-risked, which is why, like, if you look at it from the book standpoint, like, whenever someone's like, hey, I should write a book, or I want to write a book. And I'll be like, well, okay, let's explore that for a second. And if you are really passionate about writing a book, don't start by writing the book. Start by writing an article or doing a webinar or something. And that allows you it almost like crowdsources the content iteration. And so by the time it turned into a book, I felt like I de-risked a lot of those fears, James, that you mentioned. I would say probably the biggest fear I had was, we happen to be entering this post-AI, this AI era, and just like that some of this stuff might change. And I had to do a lot of thinking about that. And when I reflected on it, I realized that, like, so many principles in the book are first principles. They don't rely on a human selling to another human via a Zoom call.
Yeah.
Right? There are things like, how do you define your ideal customer profile and the formula behind that? Whether that's agents selling to agents or humans selling to humans, it applies. Like, how do you run a good revenue forecast so it's accurate? These are things that are formulas that don't really change in a post-AI era. And as I reflected on it, I was like, this work continues to be important now for people to figure this stuff out, but we're always going to want to scale revenue and acquire customers no matter where the AI era takes us. And this is an important time for first principles as well as we start building those agents. So that was like a little bit of concern. I know we're going to get into that too. I would say the other thing is like, I guess the fear was we've always had this like power law, go big or go home, go fast and break things mentality in entrepreneurship, which is important. And I don't disagree with it. And it's not that the work says slow down. It's that the work says speed up at the right time and the right pace. And I would say like when I meet people, I would say probably 45% of my entrepreneurs I meet are going too slow, 45% are going too fast, and maybe 10% are going in the right pace. So like that was probably another concern was we always have this mentality of go fast, especially right now, right? Burn a ton of capital, go fast. And I think generally the sentiment is too much right now. It's a little bubbly. But that's always a little concern too, James, of like the details of some of those reflections.
I think it's important to keep going back to the fact there that you crowdfunded, you spoke to people, you started with conversations. Obviously the SaaS stage showed you. But I guess you always knew deep down when you're doing the work that you've been doing with your Harvard Business School and the investing, the data doesn't lie, does it? So even if people don't believe it, they just don't want to believe it because you've got all the data that tells you that this is what's happening.
Yeah, and it's I kind of sourced throughout. It's not like I was the only study. I've sourced a lot of like colleagues and people who've done very rigorous research on that through the content and the book that supports these principles. And it's not like it's just one of those intuitive things that it's like very difficult to debate once you see it in first principle format.
I'd like to take it back to when you were at Upscale so that we can get the audience to see and feel that you've been there and done it. So
sure,
there's a moment every founder's journey where they go from that scrappy startup to we need to scale right now.
Yeah.
And that can be the moment where it can go very wrong, which we see all the time. So when you were at HubSpot, were there specific circumstances, the board meetings, numbers that you saw and conversations that you were having every day where you realised if we just go and hire 10 salespeople right now, we could be making a really big mistake?
Yeah. I mean, I think all the members of the founding team would say that we messed up a lot of these things. It wasn't because we were not smart. It was because we were in the early parts of the cloud transition 20 years ago. And I think it took us and the entire industry to realize one of the first key conclusions of that era, which was that customer success and retention was such an important North Star that hadn't existed in the on-prem era. And so I think that's where we were off in our early days, and it almost cost us. You know, none of these startups that you read about or these big companies that you read about were easy journeys in the build stage. Just as an example, because of this particular oversight, our churn, badly. It was actually 8% in the month of February of 2008, I think. Like, just think about that, James. You lose 8% of your customers in 1 month. When you annualize that, it means all your companies turn over every year. It was very difficult for us to get that Series B. And even our Series C, like we went around Brian and Dharmesh went around the valley and barely got it done. Like everybody passed. And so it almost killed us. But we were hyper-focused on it and got through it. So we learned. I think that was one of the things that I deeply respect around Brian and Dharmesh was like they always put the company on the line and made the bold decisions, looked really hard, truthfully in the mirror, and that's what saved us. I would say one element of what we did do from a scaling standpoint that I took, Brian guided me on this, that is now one of the principles of the science of scaling was we didn't get the fundraise and then, look around and we had 2 salespeople and be like, okay, we just got this fundraise. Let's go hire 12 salespeople next month, which you probably lived through a lot, James, and and that's something that's a pothole that I find a lot of these founders and boards fall into is they're doing the math on okay, we just did this big raise. We just sold them on this valuation, which we sold them on this revenue number. And I'm doing the math and I need to add 5 million. So I need to add 10 reps next week. And even though we only have 2, and that's just I think Brian really understood, cause he's been a sales leader and before that you just don't have your operating cadence instrumented to hire and ramp and enable that many reps that quickly. And so he was more about a pacing. He was like, okay, we're ready to scale, hire 1 rep a month. And that was like brilliant. Like very, very few operators and boards think that way. It's more about a pacing as opposed to lump sum hiring and like cross your fingers.
So the churn, the leaky bucket, lots of people refer to it. It's an ongoing challenge. And, you know, I work and I place a lot of VPs of sales. And, you know, when you're qualifying the role and then when you're talking to VP of sales, everything is focused around revenue. But then you realise they've got a churn problem, which, by the way, it's like back 10 years ago when everything was on-prem, it was really hard to switch something off when you sold multi-million.
So churn didn't matter.
Didn't matter, right? But today it can be so easy to switch off and switch something else on. How do we because if people are still at Series B, bringing in a VP saying, right, how are you going to hit your revenue target in the first month? When I know all the brilliant CROs will go in and they'll spend that first just analysing, looking and understanding and then starting to look at churn and fixing that. But how do we change the mentality? If the mentality is still, even at kind of growth stage, is revenue.
Yeah. It's such an important question and grows in importance, James, even in the AI era, because it's even easier to like switch tools and the churn is an even bigger North Star. So just to like root your question in the framework and then get back to the specifics around revenue accountability and sales leadership accountability. You know, within if we step back from like the 3 phases of the science of scaling method and we talk about it qualitatively, the first milestone you need to achieve is consistent customer value creation, not consistent revenue acquisition. Like we have to look at the definition of sales, and if I could broaden that to be go-to-market, is not to get a contract and a payment. It's to deliver the value we promise to a customer. That's when the flywheel on the go-to-market machine works. And so that's our first milestone, is consistent customer value creation. In most of the worlds that we work in, James, software, et cetera, and in fact, in a lot of businesses, that is measured by customer retention. Right, so like a customer bought your product, used your product, and essentially decided to rebuy it. And that's the best way to quantify this, you know, customer value creation. Now, I happen to call this product market fit. I think, you know, I just think that's a term that's been around and everybody gravitates to it, but no one defines it concretely around the metrics. They're like, oh, it's a feeling, you know, like, and I just would like, you know, in the methodology, I suggest, like you have to find product market fit first, but let's not be subjective about it. Let's make product market fit not around customer acquisition or revenue acquisition. Let's make it about customer value creation, and let's quantify it as customer retention. And then, as you alluded, James, that is a lagging indicator. So we have to like talk about leading indicators of retention, or LIRs. So that's just like, that's the first bucket, is product market fit. Then once we've proven that, you move to step 2, which is go-to-market fit, which qualitatively means we can create that customer value profitably, right? So like in the first phases, it's like, do unscalable things early, like go around, find these people, like what Paul Graham at Y Combinator says, just do whatever it takes to get people onto this product and create value. And once you can do that consistently, let's build a business and let's make this profitable. Let's make sure that we can generate more revenue through a rep or a marketing dollar than it's costing us. And so usually we talk about that as unit economics, and I call that go-to-market fit. And once you have those two, you're ready to scale and we can move into growth. A general picture for the audience of the methodology: find product market fit as defined by customer value creation, then move on to go-to-market fit as defined as acquiring those customers profitably and creating that value. And then you can move to growth and moat. Now, how do you align the org around that, James? Well, there's always, like most go-to-market orgs, especially salespeople, today at least, their behavior is best driven through the sales compensation plan, whether you're talking about your CRO or your sales rep. Let's just talk about at the sales rep stage. You know, I think a really good technique is when a rep closes a deal, pay them half the money when they get the payment and half the money when the customer achieves the leading indicator of retention. That's a really easy way to align the salesperson with the retention, the value of the customer. And so this lead indicator retention that you allude to, James, is basically what happens, what behavior or action or something that we can see amongst this customer in their first month with us that if that happens, they'll be with us forever. And if it doesn't, then they won't.
Yeah.
And so like the lead example I give is in Slack, a product where many of us are like knowledgeable about. It was if the customer sends 2,000 team messages a month, that's the lead indicator. So like that's really cool, right? Imagine being an early rep at Slack, and it's like compare to one comp plan where the rep is basically paid when the customer pays them. There's nothing in there that checks value versus the rep is paid half when the customer pays them and half when the customer sends 2,000 team messages in a month. Which, by the way, in Slack's case, if they had that comp plan, I bet reps would have set up their prospects on a free trial and got them achieving that goal before they even signed the contract, which sets up a beautiful foundation for healthy customer acquisition.
I'd love to dive into that in a bit more detail, because as you know, I'm placing salespeople every week from the businesses within stage 2. Because the idea, the theory behind that comp plan sounds absolutely bang on.
Right. And I've used it at a lot of companies, right? This is not like an Ivy Tower. Go ahead, James. Yeah.
I'd like to hear it because I'm a big believer in pay for the behaviors you want. Okay.
Right.
And just setting you up, I'm going to follow this up with, if you've got that payment plan in place, there's a certain type of salesperson that you need to hire. So you need to be aware of that as well, because you eliminate certain types of salespeople from it. So first of all, I'd like to understand, where are you seeing it work and how has it benefited both the salesperson and the business?
Well, it just aligns everybody. If you take the normal approach, okay, let's just pay our reps, let's give them $1 million quota and then pay them according to that. That's one of the reasons why you see that such a high failure rate in startups, is because that person's going to go out and you'll probably grow faster revenue in the short term, but you run the risk, and it usually happens that you end up with a lot of bad fit customers. It's actually surprising to many boards and founders that when you look under the hood at the root cause of a churn issue, it isn't usually product or onboarding. It's usually the sale. And that was definitely the case at HubSpot too when we went through it. It's like we just weren't precise about the type of customer that we built the product for. And we weren't holding the sales team accountable to setting fair expectations with the customer on what was required to enable the value on their part and what value they could even expect. Like you just run the risk that reps are like, they'll just say like, hey, just buy this thing and it's going to create like 10x ROI. And there's no expectation of like what's needed and like whether that ROI is even possible. So that's what causes a lot of issues. And this particular comp plan, now like the type of rep, it probably like, and you probably would be even closer to this than I would, James, of like, if you compare the rep that's going to succeed in the legacy model where you just pay them based on revenue acquisition versus a more modern model where you're paying them around lifetime value acquisition, basically. I think in all cases, it just leads to a better salesperson. Because like, I think at the core, like the greatest salespeople, they almost like, the best metaphor I could say is like, they're more like a doctor, where like, you don't go to the doctor's office and they're like, hey, James, before we get to you, I want you to check out this new heart medicine I just got in. They're not just like, they're like, James, why are you here? What's wrong with your knee? How did it happen? Do you have any history around it? If I move it this way, does it hurt? Like, that's probably the best metaphor. And when a seller sells like that, they're selling at the highest level of the sales profession. And they're more like a consultant finding the right solution for the buyer than they are trying to push something onto the buyer.
Every conversation that I've had with CROs that have been doing turnarounds and they talk about the leaky bucket, once they've done all the research they need and they've looked at all the data, every time it comes back to a sales issue. Every time. Right. And I think the really straightforward way that you solve that is you hire on a characteristic of accountability. If you hire someone who is accountable for what the business is trying to achieve, they'll be aligned with it and they'll do it. It's much easier to just go and sell seats and revenue and then throw it over the fence. But if you pay me that way, if that's how I earn my double OTE, I'm going to go out and do that because that's how you're rewarding the behaviors. When you then try and change that, there are salespeople that make good numbers, and when you sit down and really talk to them about the business, they'll be like, it's not my problem, someone else's problem.
Totally.
And they haven't got that accountability characteristics. And I'm not one here to say where accountability sits and the characteristics that people should hold. It all depends on what you're trying to achieve as a business. But if you are looking to solve that churn problem and you want to bring everybody into play, because I think everybody has to be involved, a salesperson has to trust customer success, how the customer success is set up. Yes. But you have to believe and be accountable for what your role in that is. But therefore you have to have hired somebody who has that trait.
Yes. Yeah, there's a lot to unpack in there, James. I mean, that's an aspirational culture, and that's an aspirational hire, to find salespeople that think long-term in the holistic culture. And that's great. I mean, I think this gets you along that direction. It's not completely necessary. Like, I still think like you can go hire egotistical, like self-serving salespeople. Like, I'm being exaggerated here, and still set up the system so it works. Like, couple things to unpack. Number one is, you know, if you choose the former and you're just going to like go hire, just get revenue for the sake of revenue. A lot of people call it in the AI era right now vibe revenue, like bad vibe revenue, like because it's all like vibe coded, like SMBs experimenting, whatever. You see a lot of that right now in the growth. It's going to catch up with you. It's almost an unrecoverable moment, because you're going to wake up in a year or two with a lot of revenue, but half of it's just churning like crazy. It's a really hard reset for a company. It's just dangerous, right? So that's like, have that in our mind. Number two is, you brought up a good point, James, is like, if you're gonna comp on, like, hold reps accountable to not just revenue acquisition, but LTV, like healthy. You sign up for some finger pointing, right? It's like they have to trust, to your point, like the CS team's gonna do a good job. They have to trust that the product is gonna live up to the expectations, which is like part of the reason why I encourage not like paying them, you know, the annual renewal or like way out there. Their job is still a very short term. And that's why I encourage paying them on the leading indicator of retention. Because like all we're saying is, like in the Slack example, you get half when they pay you and half when they send 2,000 team messages in a month. And like, there's not a lot of risk around that. We have hundreds of companies that are sending 2,000 team messages a month. Yes, maybe they hit a product bug during the trial. So hopefully we can eliminate those. And that's problematic. But like, if these folks are humming along and then 8 months later they have experience with our customer support person, or maybe like the whole, you know, everything goes down for like 5 minutes and their business is like it just gets affected and they get pissed. Yeah. That doesn't hurt the reps comp. Like they all they cared about was upfront. And so like those aren't good things, nor are they really the responsibility of the salesperson. And so by comping them on the lead indicator of retention, you kind of mitigate some of those cultural issues and accountabilities.
I think also everything can be solved normally in a really good explanation as to what we're trying to do. I think some comp plans were designed over the last 10 years to just get sellers in and you're going to make loads of money by hitting revenue numbers. And that's muddied the water somewhat and saying, right, that actually isn't right. We need to make it right, but there needs to be a strong explanation in behind it. I think how you tell the story, I think, is an important part of it. I want to take it back to product market fit, because I think this is, particularly in the early stage, is a critical one, because you have your P% of customers achieving E events with T days from the book. Yep. It's really precise, it's measurable. But like what you mentioned before, when I'm qualifying jobs and I ask if you've got product market fit, they say yes. I think they expect me to just tick that box. Yes, they've got product market fit. But when I follow it up with, how do you know? Why?
Yeah, exactly.
Yeah, how do you know? It's normally, we can't keep up with demand.
Right.
That's the answer. And it's just like, I don't know if that's product market fit or not.
No.
So why do you think, because I think this is the foundation of everything that you've spoken of there. Why are early stage founders not wanting to measure, to really truly understand data points that they have product market fit? Are they afraid of something?
Probably not. I think they just don't know how to measure it. And you highlight a really good example that most people confuse product market fit around revenue acquisition. They either say, I have product market fit when I have $1 million in revenue, or I have product market fit when I have 20 customers, or I have product market fit when I have tons of inbound demand, the example you said. That doesn't, the underlying, like when you think about product market fit, it means that like you built a product that continually generates the value you promised to the market. Like I can sell ice to Eskimos, but they don't need ice, right? And like even like factually speaking, if I look at any business that has a ton of inbound demand, I've never seen a business where over 50% of their inbound leads should be sold to. It's just like, that's crazy. It's just like you just didn't build a product that broad. And so like the level of inbound, yeah, sure, this means you're good at marketing, that there's some pull in the market. But it doesn't mean that you built a product that's going to suffice that pull.
Yeah.
Right. So that like, I don't know if I find that like they're necessarily resistant to defining it or measuring it. I think they just don't know how. And I just would encourage them to base product market fit in the long term on retention. And in the short term, to your point, James, the leading indicator of retention of what you could see in the first month of your customers, that if that happens, they will be with you forever. And you're quoting the framework, which is 3 variables. P% of customers do e-event every T time. 80% of customers send 2,000 team messages in Slack every month. 80% of customers use 5 or more features in the HubSpot platform every month. 80% of customers back up their device at Dropbox every day. Like you can see the pattern. That is the definition of product market fit.
Most founders, they see product market fit as a byproduct of the revenue activities. Now, how much of that falls at the responsibilities of VCs? And the reason why I say that, I love stage 2. And the reason why I love stage 2 is that before stage 2 arrived, I was working with VCs, and their biggest challenge, they'll say, is go to market. But their strategy was always grow at all costs. It's super aggressive, and it's follow the formula that worked at A, B, and C. But they're playing a numbers game, right? So they know that it's 1 in 6, like just for argument's sake, it's 1 in 6. So early stage founders are, I need revenue and I just need numbers. So if there's a ton of leads, yes, I can sell to every single one of those leads because they're all interested. And once they see my product, they'll know it's amazing and they'll want to buy it. So I guess what I'm saying is the founder's mindset set from the way VCs have been setting them up?
In a lot of cases. Partially right, partially wrong. It like sometimes surfaces a little bit of like natural misalignment between the VC and the founder. So, venture capital as an asset class operates under a power law, which means that it's not like a mutual fund where like your stocks either perform at like 2% growth or 7% growth. In venture capital, it's like 1 in every 10 succeeds, but that success is so massive that it significantly outweighs all the losses of the rest. Like there's very few firms where half the investments work out. So the VCs are correct in pushing you to like grow crazy fast to prove that you can break through the noise and get there. That's fine. And I think like where it's messed up a bit is just, again, the timing of when that occurs and the pacing. And like a couple examples here is like, okay, you set an annual plan. You're like a small company, 2-3 million, and you set up an annual plan to go to 10 million. And you missed the first quarter, and a lot of VCs are like, oh, you missed, hire more people to catch up. That doesn't make sense at all. The reason you missed is because something's broken in the go-to-market system. And by hiring more people, you just dig a deeper trough, which is represented as burn, and you just kill yourself faster.
Yeah.
And like, it doesn't make sense. Like, we're not going to sell this business this year. Like we're trying to, if it works out, we're going to try to sell this business in 5 or 7 years. And no one's going to ask us what our growth rate was 5 years ago from Q2. But I get intuitively why they think that way, because a lot of them have more of like a finance mindset, and they're doing like the math on what their like quarter over quarter IRR should be for what they underwrote the investment to, and like they're trying to keep it on that IRR, but operationally it makes no sense. The other thing that's happening there too is like some of them might just be working the game. Like they just want to know, are you going to break out or not? Are you one of the 10? or you're the 9 that is not going to work out. I just want to know sooner than later so I can get off your board. Like, I just want you to either like go home or fail. And that's where the misalignment is for VCs. You're 1 in a 20 portfolio bet as a founder. As a founder, this is your decade bet, your only decade bet. And so like if I'm being founder coach for a second, it's like, please pay attention here. More wealth is created in startups, in non-venture backed startups. This is not the only way. And so first off, be very aware when you raise money from VCs, what you're signing up to. And also be aware that like your incentives are not always aligned. And you may get some signals in the business. You may thought you were going to go from 0 to 10 billion. And like 2 years in, you might have realized it's not there. You can still make a lot of money. It's not what the VCs want to hear, but like you can get this thing down to rule of 40, profitable with a really insulated moat, and sell this thing for 200 million in like a couple years to a private equity shop or an acquirer. And that's going to be a massive miss for your VC. But you personally are going to make 50 million bucks. But like a lot of founders miss that and fail and go to 0.
It's because it's the fear of missing out, isn't it? And it comes back to the age-old, someone else is scaling super fast and you feel that the only way to match them is to hire people. And I think now it's becoming really clear that over the last 10, 15 years, people have been the answer to all the problems. And actually it's not, or the number of people isn't the answer to the problem. Because even to the part where you mentioned you haven't hit your number of quarter, hire more sales reps. Even worse, I've been in situations where they've sacked all the salespeople and said, like, hire more, but yet the number still doesn't change. It's like, we've got a ramp period to get them up to speed. You're never going to get to the number by doing this, but that's the path that goes.
Yeah. But let's make sure before you ask your question, James, like, let's do the counter argument to that just to play it out. Like, there's a great work out there, Blitz Scaling by Chrissy and Reid Hoffman, that has extraordinary merit. And it just means like you do have to go crazy fast to break through. Like, well, I'm just talking about the situation now where like you get off pace. It isn't the $10 billion opportunity you thought. You can go to rule of 40. That doesn't always work out. To like the work of Blitz Scaling is like you leave yourself vulnerable from the person that's raising the $50 million round, the $100 million round, getting the best engineers, getting the front page of the press, getting the best customers. Yes, like if you're going after an AI-enabled CRM now, you have to play that game. But like, you don't always have to. And if you're going after an AI-enabled CRM and you lose and you're losing, like you can switch to like AI-enabled CRM for pharmaceutical companies and have a beautiful moat in there and sell this thing for 200 or 300 million. Like you have some optionality. I just don't think people realize that. And I also think like, where's the extent of blitz scaling? Are we going to burn $1 trillion a year? No. But where's the extent? Like, where's the right limit? And then finally, within the blitz scaling mentality, I'll get back to it. I missed that last point. But you get what I'm saying is like, it's very good work. And there's a downside to going too slow. You have to kind of burn it out. But like, we have to understand where the limit is and understand your option. I guess the other point I was going to make, James, is like first mover advantage is overblown from a rigorous study standpoint. Go ahead, go do some research. Find me a study that shows that the first mover usually wins. Google wasn't the first search engine. Apple wasn't the first iPhone. Like Salesforce wasn't the first cloud-based CRM. Like now as we enter the AI era, be careful believing that the first movers in each of these categories ultimately wins, and study why.
I can't remember where I heard it or saw it, but you always want to be the second mouse to the cheese.
It's easier. I mean, the first move, here's like intuitive like why. It's like the first mover has to spend so much money on product mistakes, trying to find product market fit. And they have to spend so much money evangelizing the market on this new concept and training the market. And gosh, the fast follower can just copy it and sell it for half the price.
Yeah.
And just say DocuSign at 50% off. Here it is.
I would also say around the blitz mentality and look, there's a place for everything, and you have to work out what's right for you. But from the founders I've spoken to, the sales leaders I speak to, it's such a stressful way to do it. And you know, everyone's got their North Star of what they want to achieve, and it's about finding the right way to it. I just think that grow at all costs causes so much more stress than it needs to, when there is other ways which are more measured, and you can still explode, but it's exploding at the right time. And also knowing that it's all right, it's correct. Now you might get it wrong, but you've done all the research and the facts into it, and the data makes sense. It's like, right, now's the time to do it, and you can do it without having that fear of, are we doing the right thing or not? Because we're just going, do you know what, someone's giving us a ton of cash. The amount of times out of COVID where I was talking to founders, they were getting their Series A funding, we'd worked out how many salespeople they needed for the target, and it was like, great news, we've got another 10 million, so we're going to need another 4 salespeople because funding's gone up. And you're like, yeah, but we've already worked out what you can achieve. So adding more salespeople into it doesn't change anything because you've got more funding. That's great, but I think you should keep your sales heads the same and your revenue target the same. So the revenue can't stay the same because we've got more funding.
Yeah, I mean, I think there's a couple things in there, which is you're highlighting the stress that comes with it. Like, first and foremost, we already discussed, like, more wealth is generated outside of VC startups than not. I have plenty of friends from when I went to school at MIT that bootstrapped their first company, sold it in 3 years for 20 million, bootstrapped the next company, sold it in 3 years for 20 million, bootstrapped the next company, sold it for 20 million. They made $60 million over the decade. That, like, that's a huge outcome. That's a good outcome for a VC-backed CEO founder. You know, they're not billionaires, but they're doing quite fine. And so, like, you can do that with niche stuff. If you're going to play the VC game, it's stressful. We're going through like 996 out here in the US and specifically in Silicon Valley, which means you work from 9 a.m. to 9 p.m. 6 days a week. And guess what? Some people are outperforming that by doing 9, 10, 7. It's almost like 6-minute halves, whatever. And that's fine. Like, I am a little worried in the long term for like mental health for these folks, but like, it's a gold rush right now. Dig in. You're 27 years old. Go for it. You know, that's fine. But you don't necessarily have to generate wealth in entrepreneurship. If you're VC backed, you probably have to go for it, especially right now in AI. And then to your point, James, is like, we can fabricate the pacing just building on where we are in the methodology right now. It's like, okay, fine, you got to 2 million. Now can we get to 10? I don't know. But let's do this. Let's look at what we've done so far. Let's just look at the mechanics of our go-to-market. How much demand are we creating every month? Like, whether through our reps, SDRs, whatever. Can we increase that by 10% a month? That seems realistic. Okay, so let's have an input there. How much of our reps closing? What's the close rate on opportunities? And how many are we adding? Can I increase that velocity by 10% a month or so? Yeah, that seems reasonable. And what's our customer retention velocity? Okay, so like, I have these tangible inputs to my system. And now it's just like, okay, let's set up our annual plan, but let's agree at the beginning of this quarter what we're going to see at the end of the quarter that would cause us to stay on this plan or go faster or go slower, stay or go or slow. Like, no one does that. Everyone like builds annual plans like we're these billion-dollar companies and we're startups. We're learning every day, every week, every quarter. So build that in. Don't abide by the annual plan. Look at what you did last quarter and figure out what the next 4 quarters look like every quarter. And like, that's a way to figure, can we go to 10 million this year? I don't know. But let's set up a plan to go to 7 and let's define what we could see at the end of this quarter that would cause us to go faster, which translates to hiring a rep or adding more marketing dollars or whatever you're using to fuel faster. And that's an aspiration for the team to hit. And we as investors can agree that, like, yeah, if we see that, and also the contrary, what would we see that would say, pull the cord, slow down, stop, fix this thing? Whether it takes a day, a week, a month, or whatever, and then let's get back on track. Just stay or go or slow.
Are you seeing now through the work that you're doing with Stage 2 that targets forecasting are being led more by the business and less so by the investor, where there was pressure of it needs to be 20% increase, 30% increase, and then it was just about the business working out how they get to that number rather than the business coming through and saying, this is the number we think we can achieve?
No, it's more the investor. That's between top down and bottom up. And that's fine. Like, I know why. Again, the investors it's on a certain IRR. You have to get to the next round. They're jealous of their buddy who made an investment in something that did go from 2 to 10 to 50. So like, that's where it comes from. And hey, we're trying to build like $1 trillion companies here. I get it. Like, I am too. But it's just like, we can be way more successful on it if we take a calculated approach on this stay or go or slow. And this is a way to suffice the investor's appetite. It's like, yeah, let's try to go from 2 to 15. That's fine. As long as we stay on the go plan then we will get there. And this is clearly what it's defined as. There's 3 dimensions to the evaluation. It's demand gen, the conversion from demand gen to customers, and the value creation within customers. So it's like, it sounds like this. It's like, okay, we're green if we're like generating 10 or more appointments per rep are generated each week. If like 80% of our team is hitting their number and 80% of our customers are hitting their lead indicator retention, we're green, and that means we're going to go faster. And then we can define yellow as a step back, and then red. And if anything hits red, then you have to stop and fix it, whether it takes a day, week, or month, whatever. You got to fix it.
That's great advice. I want to move it on because there's something you mentioned which is close to my heart, the best salesperson trap. You've got lots of research that shows, I've got lots of research that shows the best salespeople don't necessarily, and more often than not, do not make the best sales manager. In fact, they're normally the worst. But that person's been with the business for the early on. They've helped them get to where they are. They want that promotion. They want the extra money, the recognition. Help founders who are in that situation. What conversation should they be having? How do they stop themselves from stalling growth by effectively putting the wrong person into play? Because I tend to switch the word VP sales to coach, because that's what I really believe a VP of sales, predominantly for salespeople, is a coach. Development of people and helping them achieve number. So how do founders who find themselves in that situation, how do they have that conversation?
Yeah, I mean, it's like another huge pothole. And there's tons of research on it. Most people promote their best salesperson to manager or leader, and there is an inverse correlation between performance in individual contributors' sales and effectiveness in leadership. So it's like, said more simply, most people promote their best rep to manager, but they make bad managers. And like the reason for that is the job description is very different. When you're a salesperson, you have to like do qualification, do discovery, work with rigor, like tailor pitches, etc. And to your point, a good sales leader hires and coaches. That's what they do. There's not a lot you learn as an individual contributor other than the actual sales methodology that helps you to hire and coach well. And so now I always like when I do a lot of exec ed teaching with this one, and they're all like, oh, I've lived through that. I've totally done that. And then I'm like, well, what's the answer? Promote your your worst rep to manager? It's a hard thing. And that's kind of what you're asking, James. It's like, first off, just self-reflect that this is the case. Don't fall into the trap. And the next thing is, what do you do about it? So you have to set up a path to leadership that isn't just hinged on being great with your revenue number. That's step number 1, is you can't promote your worst rep to manager. You can't promote someone that isn't doing the job. And the job is just hitting quota. So the first qualification to get to management or leadership is just hit your quota consistently. Like this year, 3 quarters in a row, whatever you wanted to say. That's the first criteria. So everybody hitting quota is qualified. And the person that's at 200% is no more qualified than the person that's 101%. They're on equal footing. It's just both of them can do the job. Okay. Then you have to put in some sort of internal process that allows someone to practice and demonstrate their ability to do the job, namely hire and coach. And there's a bunch of ways to do that. I personally have set up very easy to reading. There's a lot of great readings on how do you coach someone? How do you give negative feedback? How do you increase morale on a team? And I've had great success in just putting together a quick little hey, read this 10-page ebook and then let's role play. It's the implementation of the practice into a sales leadership context. It helps someone practice. It helps someone demonstrate that they can do these things. And it also helps them self-assess out of I didn't know this was the job. I don't even want to do this, right? And then you can also create situations where a salesperson can hire someone and mentor them for 2 quarters. Now, I don't like the permanent team lead where someone has half a quota for themselves and half a team. That doesn't work. Yeah. But to ask someone for 2 quarters to continue to do their job, but just carve out an extra 4 hours a week to do a bunch of interviews, hire someone, and then coach them. What a great way to do a final step to make sure they can do this and to really practice the skills. So that's the answer, James, is don't fall into the pothole. Don't promote your best rep to manager. Set up an internal process to get there, starting with making goal continuously.
Just to add on to that, how often also, regardless of whether you've got the situation where your best rep wants to be a sales manager, how do you handle the situation where your early stage salespeople and the criteria that you hire against to get the foundation and the ship up and running, they aren't usually the right salespeople for scaling?
Yes.
So not only are they might not necessarily right for being the sales leader, but are they necessarily right for the business at all for the next stage?
Yeah, that's a great question. Let me abstract that out here, which is the other framework that the book rests on is not just the find product market fit, then go to market fit, then you're ready to scale and move into growth and moat, and clearly defines those milestones and uses your own data to know when to scale. But it also defines a go-to-market system, right? It sits on the market that you hypothesize you're selling to, your ideal customer profile, that allows you to define a buyer journey on how they buy and allows you to construct a sales methodology to help them buy. That's kind of the foundation. The inputs to it are the demand we create and the people we hire to service that demand and make them customers and make them successful customers. And it runs on how we coach and pay our people that spits out activities like demos that lead to a forecast that lead to revenue. Okay, so that's like, hopefully you can start to see the system, and there's components in that system: the methodology, the target market, the hiring, the compensation plan, and you're specifically asking about the hiring. Now, one of the key things to go-to-market system design is there's never a universal answer. I've had to unfortunately part ways with a lot of salespeople over my career, and those salespeople have gone off and been successful at other companies. It's not because we were messed up. It's because all these components need to be designed and optimized for the context of the business. If you're selling pencils versus jets, you can imagine different attributes of people you want to be hiring, different comp plans, different sales methodologies, different pricing models, right? So you're optimizing the components around your context, which is usually the product you're selling and your buyer, and something about your business, which can be the stage. So that's the outer abstract definition here, James. And what you're poking at is one of the components is who you hire, and the context is the stage you're at. And that's really what the book explores, is how do these component designs change as you go from product market fit to growth to go to market fit to growth and moat. And you're absolutely right. The number one salesperson at Workday right now would be a terrible first hire for a startup. They're a process executor. They walked in, they went through a month of training, all the objection handling, a sales manager there to help them, the demo deck's ready to go, the prospecting sequence is ready to go, the comp plan, and they just go in there and execute. That is not where you're at in product market fit phase. You are your first sales hire is the first time that you're going to touch the market 20 times a week. And if you hire that number one rep at Workday, they're just going to come back and be like, it's not working. I'm giving the pitch and no one's buying. You need someone who's going to say, I talked to 20 people and this is the opportunity in the market. And this is how we need to grasp that opportunity. So they need to almost be half product manager, half account executive.
Totally. Look, really appreciate your thought process. I know we are fast running out of time, but I've got a couple more questions if that's okay. First one's quite a straightforward one. Stage 2 applicants. You're not just teaching this, you're investing in businesses based on it, right?
Yes.
So when you look at potential business that you might invest in, what's the first metric that you check to see if they are actually ready to scale versus just having good revenue growth?
Yeah, the leading indicator of retention is are they, said qualitatively, are they consistently creating the value they promised to their customers? And that the way we quantify that is lead indicator retention. It's rare to find a startup that has already operationalized it. Usually we have to work with them and dig into the user logs and help them create it. But that when you have that, that's an amazing foundation by which to build a business. It's very hard to create out of the gate, but that's your first North Star.
I'm glad you said that because this whole conversation might not have made a lot of sense if you
yeah, exactly.
hadn't have said that. Right, one final question. Let's go 30 years forward from here. I say 30 years, that puts you maybe close to the end of your career. Looking back, if this framework, this book that's coming out, now genuinely changes how founders think about scaling. What does that world look like? What's different? And what I really would like to understand is, what does it mean to you personally? Because let's be honest, you don't need to do this. You don't need to write a book. You don't even need to do stage 2. So why does this specifically matter to Mark?
Yeah, I would say the first part of like what might you see is like you'd see a much lower failure rate among startups. And we've unpacked a whole bunch of ones, and it's just a fraction of what we talk about in the book. We've unpacked like choosing the right capital partner, choosing the right pacing, choosing the right leadership, etc. And it's just a lot of unnecessary failure, because I guess the next piece to your question is like, because we have an opportunity to treat this sales, go-to-market, revenue acquisition as more of a science, like we think about strategy and economics and finance. So that's like really motivating to me, and I think the opportunity we have. And for me, I don't know, it gets outside of like the typical business discussion, but I'm a little more like, I suppose, like a Buddhist Hindu type calling, where I'm just like constantly reflecting on a daily basis the unique gifts I've been given as a human and how I should deploy those gifts to enhance humanity and society. And right now that's what this I'm also like a deacon at my local church. I'm a dad to 2 boys. Like there's a lot of ways I express these things. And it just, we're happen to be talking about this one, which I've been given this gift, this passion of entrepreneurship, this gift around go-to-market design. And I just want to find scalable ways to help the ecosystem. And I think that's my unique thing right now. And that might change. But right now, that's what we're talking about. It's an opportunity to drive some proceeds for mental health as well, which is also important to me.
Absolutely. And this book is out this week, is that right?
It's been out. Yeah, it came out in the early part of February. You can check. Amazon's probably the best place, but anywhere you buy books, it's listed there.
Amazing. Well, look, Mark, I really appreciate you taking time out to come and talk to us. I think you're solving or helping solving a big challenge that I've been seeing, and it will certainly help my life as a recruiter. People think as a recruiter you just want all the jobs and hire lots of people, but it's not actually true. It does the opposite. So thank you personally, and thank you for all the advice and guidance, and I'm sure the book will be flying off the shelves like all your others.
Thank you, James. Appreciate the support.